Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hi, everybody. Welcome to Vantage Point with True North Wealth Partners. I'm Andy.
Eric Susie.
Tuesday, the 21st of June.
Halfway through the year.
Burning through the summer. Or I guess today's the first day of summer.
First day of summer. Amen. I hear you. Wow, episode 24, folks. 2 years. Woo!
Crazy.
Well, yeah, there's lots been going on, that's for sure. But doing good? Family all right? Hanging in there?
Yeah, doing good.
Away. It's always something, right?
Always something. No, we're doing well.
Yeah, I hear you, man. Yeah. Well, we got a lot going to it. Let's get into it.
Yeah,
more good charts. We have a recovery tracker. What's happening there with the economy and things reopening?
Yeah, crazy times, isn't it?
Yep.
Yeah, but I guess some sun, there's a lot of storm clouds, right? But there's some sunshine.
There's some sunshine. Yep.
The economy, even though it's slowing, right?
Yeah.
Still some segments of growth, which is good. So you got low unemployment historically right now still, so that's good. Retail sales are up.
Yep.
Service sector opening back up, which is good. So jobless claims are down. Box office receipts down. What's up with that?
Everyone's swimming. It's too hot.
You can sit at home and
The climate change is killing us. We're all in the pool.
That's right.
Sorry, folks.
That's right. We went to a movie and it was fairly crowded. Yeah. But anyhow, hotel occupancy is down. Yeah, so it's going to be interesting to see. Yeah.
Canceling flights. A lot of flights. A lot of weird stuff going on in the flights. So we'll see.
Yeah, gas is up.
Yeah. What else is new?
Yeah, I had to sell my Bitcoin. My Bitcoin is down 60%, so I could fill up my gas tank. And gas is.
So let's talk about Bitcoin briefly, since you brought that up at this stage.
Yeah, sure.
So it's last week, over the past 2 weeks. So Bitcoin, all that. Like we talked last time, it's the most volatile asset class. Then natural gas, second most volatile asset class that's out there. But it pretty much crashed.
Yeah.
So Coinbase, wants to lay off 18% of the workers. There's other parts of the crypto. Either people can't get out and sell their currencies, or having issues just with the default in general. And over the weekend, you and I were chatting away. What did it hit over the weekend? Sub 18, right?
Yeah, it hit below 20,000.
So below 18 for a moment there.
Yeah, it was. Yeah.
So that's how fast and volatile today's update. So today's a relief rally in the markets, but everything was oversold, well overdue. But it's crazy times in that world, and that's why we're letting that ferment and wait until it gets regulated, and then we'll take a look at it more.
Yeah. How would you like that to be our currency?
Oh, geez. Yeah, folks. There's a mayor or someone who wants his salaries in Bitcoin or something.
A guy in Florida,
I think. Or I'm like, really, dude? Like Venezuela. That's what they do. All these foreign, third world countries are using it. How's that treating you?
I mean, literally, that's crazy. No thanks.
Thank you.
No thanks on that.
I hear you.
So what's this bear market talk we keep hearing about? Right, we've had this run for the last 12 years or so.
Yep. So it's different parts. So you have like a 5% still pull back. That's normal. Happens almost 4.6 times a year. Corrections 10% or more. Then it gets to 15%, which is entering that ugly bear market. But then once you hit 20%, you're officially in a bear market. All right, so we officially hit a bear market in the S&P 500. Plenty of other indexes that are out there. Small cap, the Russell, NASDAQ, the Dow, yada, yada, yada. But the S&P 500 is a broad index. It's 500 companies. That's what we use mostly. Just like if you want to put hey, how's the direction of the markets? You want to sort of follow that one in general, just because it's a little more well-rounded. It's not too techy. It's not too old dog, 30 Dow, what have you. So that's why we follow that. So, it crashed about 23% last week. Okay, so we're in a bear market. So now the question is, does the economy go into a recession? And if so, how long and how deep? That's the two questions. How long and how deep will it last?
Sure.
So, and you and I talked last time, the first quarter GDP was minus 1.5%, so a negative 1.5% print. This quarter, Bank of Atlanta came out saying, okay, the latest revision is 0. It's flat for GDP. So, we use other folks, Argus, Hedgeye, what have you, First Trust. Other ones are higher than that, so just barely above 0. But the point is this, the second quarter GDP is going to come in flat or just whatever. A tick to the higher or a tick to the lower, but it's just going to be, let's call it flat.
Yeah.
But if it's negative, then technically you have your recession. You have to have 2 negative GDP quarters of negative growth by definition. So that's sort of where we're at as far as the bear market. We talked about the bounce. Everything was way oversold last week. So, and when you see the energy down 17% in 1 week, and materials, industrials, energy, your top 3 all year to date, and when those start, they all turned, you're getting close to capitulation, and that's where, okay, you throw the baby out with the bath, Right. So, it is sort of, but that's just sort of how it was last week. This is going to be a relief rally. Now, remind you, we had quadruple witching. It was
Friday.
Most trades, and I'm going by memory now, 8.8. I think it was 8.8
ever
billion trades. It was the highest. Year to date, I track it year to date, so it's the highest for quadruple witching. It might be ever, but the point is, it's one of the highest, what have you. So it's just a lot of adjustments, puts and calls, options, everything had to get readjusted. So that's why they had to throw a lot of the good companies, sell everything just to readjust portfolio alignments, rebalancing, things of that nature. So, I looked at that over the weekend, and I forgot the number, but I think it's like 8.8 billion trades. Again, highest,
that's a lot of trades.
Highest year to date. So there you go.
That's a lot of.
Yes, a lot of entries. You got it. So more volatility. We're still going to have it. We're coming to the month end, quarter end, window dressing. So this is what's going on. Great, we'll take it while we have it. But the other foot hasn't landed yet. That was the title of last month's episode. We're getting closer to getting that bottom. So once we bottom out, I predict in about 2 months will be that bottom. So as the Fed raises again at the end of July, I believe, we talked about this, at 75 basis points, because they're going to see a high print of CPI, Consumer Price Index print. It's going to come out for June. It'll be north of 8% again. So they're going to look at each other and go, ooh, we didn't stop it. They think by raising rates is going to stop the inflation. That's not what it does. It just slows the economy and crushes everyone and puts you into a recession. So that's where we're at with the stage of everything. And I have some charts. We'll go through the charts at the end. So, but answering sort of where we're at.
All could have been prevented.
Amen. It could have. Jeez.
All could have been
the
prevented.
Money supply and too. Let's just keep on spending and printing. Oh, build back better money. You know what?
Yeah, too much money.
Too much money. Yeah.
Too much money. So
that's what happens.
We're good. Yeah.
What else?
Yeah. So what? So in situations like this, what's the best for clients out there? Might be wondering, right? They're getting statements, seeing, my account's down, obviously for the year. What do you recommend?
Well, you and I, we've been pretty aggressive. We have cash on the side. We've raised some cash, so we've done all that. So taking preventative measures and just readjusting and tweaking some swapping funds around. So clients, you've seen all that. We've done that pretty much all year long. So we're staying ahead of it as best we can. And we still have powder dry, which I'm waiting to redeploy.
Right.
But just it is what it is. So just know that you are all losing a lot less than the benchmarks. Let's check. So that's what we got into this year, saying that as far as the alpha that we would provide, because we knew this was sort of going to be coming, and it's faster and worse than we thought. But it's again could have been prevented. But So just, when you see your statements, you'll be not too pleased, but again, compared to all the benchmarks, we're basically almost half the S&P, et cetera. So depending on what models and things of that nature.
Sure. Yeah, depending on risk. Yeah.
On risk level.
Yeah. Yeah. Long term, right?
Long term. Yep. And
this could be a bump in the road.
And then we're getting closer. So another 2 months or so, hopefully, I anticipate. Not to get real philosophical here, but it's like the fourth turning. Okay, you hear that, but fourth turning is when you get to crisis mode. So we're in the crisis mode now. This year is the crisis mode. So once you hit that oh crap moment, which we're going to hit by next few months here, then you come out of it. So and then you got the elections in November. Put a stop to the madness. That will definitely help, and then go from there. So. Got the bearing grinning a little bit more, but we're on top of it, and we're making the appropriate adjustments accordingly.
Yeah, good stuff.
Yeah, and then we talk that way. I mean, Friday. Sorry, 8.5 billion. I wrote it down. Okay. I said 8.8. Scratch that. 8.5 billion trades. That's the highest trading volume year to date. That was on Friday. I thought I did. I just couldn't find it. And it's the worst week last week for the S&P since 2020. And then we had the quadruple witching, like I said on Friday, which was stock futures indexes, options, futures, stock options, and stock index futures. So they all expire. 4 of them expire every 4 months, quarterly. Yeah, I should say. So that's just a recap on what happened last week. What's interesting and sort of sad, and Andy and I are on calls and we read a ton and what have you, but Federal Reserve, yes, they raised it 75 basis points in June. Mm-hmm. They're going to raise it probably again another 75 basis points, like we said earlier, because they're still behind. But my point is this: what's scary? This is coming from the CNBC on Friday, June 17th. 61% of Americans are living paycheck to paycheck. So that's pretty scary, and that's a high number there. So just to read another sentence or two about this. So, although people are getting wages, they're getting higher wages, but it hasn't really kept up with inflation. So, in fact, increases in rent, food, gas prices are making it difficult for workers to cover their expenses. In April, 61% of consumers reported living paycheck to paycheck, and that number will likely increase as prices continue to remain high and borrowing costs go up as well. Surprisingly, this is a kicker. 36% of employees earning over $100,000 or more are also living paycheck to paycheck. Wow. So that just tells you, and that has doubled from 2019.
Wow,
that
a few years.
Wow. A couple years. And then in addition, a quarter of Americans are delaying retirement because of disruptive savings and the current economic upheaval that we're in this year. And it doesn't surprise us, but then we're hearing it from our clients as well. We go through it, hey, good time, bad time to do things, what have you. And I think you have something else about that as well.
Yeah, with budgeting, right? Because we always talk about we're doing retirement planning, right? What's like, what's your budget? How much do you need to live off of? And that's why it's important to look at it and have a budget, pre-retirement and retirement. Right. Barron's had an article about they surveyed 1,000 Americans between the age of 18 and 44, and they asked, and they found that 59% of the respondents, they cringed at the thought of checking their bank account balance.
That's not good.
Just checking your, logging and checking your bank account balance. They cringe, and then also the majority of them said that 54% said that they would rather spend time with an ex than to create a budget.
Oh, jeez. I don't know about that one. Oh, boy.
That's crazy.
That's getting desperate.
Yeah. Yeah. So it's just
tough times.
Yeah. But, it is, you don't want to put your head in the sand, right? It's easy to do that. You still want to be proactive. Especially with your budget when it's like, I always tell when someone's getting ready to retire, practice, try to live on that, 6 months before you retire. But have a budget in place. Every dollar has a place, right? Every dollar has a name where it needs to go. Dave Ramsey has some tools. We have some tools that we use with clients. So we can help with budgeting. So if you're struggling with budgeting or you want to know, how do I check it? How do I do it? Reach out to us and we can definitely help you with
tools,
that.
That's for sure.
Yep.
No, and then just getting back there, talked about the Fed raising rates, et cetera. But this is interesting too. 91% of all mortgages have rates less than 5%, so 5% or under. And that, this comes from Hedgeye, okay, one of the research centers we use. And then another point from them, every 10% decrease in the stock market valuation equates to a 1% decrease in GDP. So think about this. So we're down over 20%. So 10 and 10, that's 2% haircut off GDP.
Wow.
Hence, so we talked about GDP forecasts, flat, nil, zero, I'm getting that flat. So it's going to be interesting, the first half of the year versus the back half of the year. So, that's just a lot's going on there. So just those two facts I thought were interesting. Markets are fairly valued, quote unquote, for the most part, but not all aspects of it. And I have a sheet once we get into a CPI. I'm going to talk about another little thing later on that. But going back to, and one other point I guess I'll hit on is this is just a call. A large bank, one of the largest in banks in the country, forecasts this. They expect about $2 billion in mortgage originations, which are refinances and purchases. Okay, refis and purchases together. They expect $2 billion combined for 2022, 2023, and 2024. So pretty much, flat, but goes back to historical averages, going back to other years. And this is just, a chart trend I'm referring to here. But so around $2 billion is what they've done in the past. 2020, it was over close to $4 billion, and then 2021, it was over $4 billion. So let's just call it $4 billion for the last 2 years, then haircut down to $2 billion for
That's
the next
half, yeah.
Yeah, for 2022, 23, 24. So the easy money, the good days for housing, come and gone, is what I'm trying to say. So it's back to normality for housing. Like we said for this year, back in December of last year, back to normal markets as far as no more propping up the stock market.
That's not necessarily a bad thing.
And it's not. You have to go through cycles. Yeah. Everything goes through cycles. Time and space. That's what we're in. So that's why I'm sitting on that. But I thought that was a little interesting and food for thought on that.
Yeah, that's good. Yeah, housing's it's an interesting to see how it's played out.
You mentioned, Columbus is a unique bird, right?
Yeah, it is. Yeah, housing's still strong here. It seems. I mean, I know my neighborhood. It's like, it's crazy.
It's a sweet spot. Yeah.
Yeah, and then you talk to realtors and they're like a realtor. Well, David Baker, talked to him, and he's things are down a little bit, but he's still busy selling, and so it's still you get multiple offers. Yep. But slowing for sure. But
And then, May existing home sales came out down 3.4% for May, but year over year, the change is minus 8.6%. That's existing home sales. So again, that was just from First Trust. So it is what it is. You have to look at the, not just Columbus, but greater. That's part of the economy as well. Yeah. And then, First Trust, he came out today, respect the bear on his Monday morning outlook here. So we follow and use. So again, he took his forecast down from 5,250 for the S&P down to 4,900 for the S&P. And now he's, quote, we don't expect the S&P to hit a new all-time high, meaning above the old high of 4,797 on the S&P anytime soon. So, he expects one of two things to happen. First, a recession will come to fruition, or the Fed will have a soft landing, which he doesn't think is going to happen. It's very, very, the odds are highly against the soft landing.
So what is a soft landing?
That the Fed can increase rates and bring in a slowing economy without putting the economy into a recession. And
the perfect scenario.
The perfect scenario, which is threading the needle, and we've been saying that. Yeah. Heck no. So it's a shame, But so we're going to be in a trading range, basically, is what he has said, and what we're talking about as well. So for the next few months, you're going to have bear market rallies, which is what we're going to see here in the next few weeks.
Yep, good.
July could be good as well, but quite frankly, I think it will reverse, especially once the Fed raises rates. So it's just going to be choppy. That VIX volatility will be the same as well. So, How about before we get into anything else on your end? Anything in particular?
No, not that I have specifically, I guess.
Maybe tips of the month. Want to hit that before we get into the ending with the charts?
Yeah, let's talk. Yeah, tips of the month. I know, just talking with clients and review meetings on the phone, it's, I've gotten some like, hey, should I stop? Should I stop putting money in the market?
Yeah,
should
I've heard
I
that
stop
too.
my 401k? And it's
The answer is
absolutely not.
no.
In fact, if you can increase that would be the strategy, because you're right. The market's down. You're buying more shares, with your money. You're getting in better pricing. And plus, the investments you have with us, investments you have in your 401s, they're reinvesting. So every month they're buying shares more at a cheaper price. So that's good. So, but it's like the stock market's the only place people cry when there's a sale.
Amen. And like growing up, the blue light special, Kmart, I loved it there. So
That's right.
I hear you.
Yeah. So keep being proactive, keep contributing. Even ratchet up if you can. Now's the time to be doing that.
Correct.
So.
Yeah. Just ratchet up, max out, or get as high as you can. Take that 1 or 2%. If you do get a raise, throw it in there.
Yeah.
You really won't miss much of it. So,
That's right.
Good. All right, folks. Well, we're going to sort of rattle off our favorite part is go through some charts. There's a lot of them. We're introducing a few new ones just because we're in a bear market. So I want to introduce, I haven't had to dust these off for a while. But let's get into it. So stock market volatility. And with that, again, the average volatility for the VIX volatility index, 30 days going out, is 18.4. Currently, as last Friday on June 17th, is 31.1. So now today it's down below the F bucket. Anything greater than 30 is very hard, challenging times to make any money. You don't. Everything loses. But again, that's where we're at with the VIX. So it's going to be volatile both up and down. You're going to see 1,000-point swings all around. This one we talked about earlier, 5% pullbacks. Okay, for the S&P 500, it's 5%. That happens on average 4.6 times a year. Currently, we had 5% pullbacks thus far. So again, like we said in December, we're going to see north of the average, and we made that call.
What year? I'm just curious. What year were there the most?
It was the 2008.
Oh, okay, that makes sense.
Great Recession.
Yeah.
24. Annual returns. This is a different look at this. So the S&P, down, had a low of 24, but it closed at 23, what have you. So that's the low point. These are just blue dots of max drawdowns and annual returns. So it's just negative, as you can see. The average year sees a stock market drop of minus 13.5%. However, most years still end in a positive territory, averaging 9% gains. So even though the markets are down 23, 24, with the average of being 13.5, however, you can still possibly end the year positive. This is going back to 1980. I'd be hard-pressed to see that this year, but there's just some stats. This is pretty cool, too. As far as valuations, you hear about the PE ratio, price to book. Third one in, price to sales, price to cash flow, and dividend yield. So you can see today is the dark diamond. So you can see we're getting back towards the ranges. The boxes you can see are the ranges, more normal ranges. Where before a year ago we were much higher. At the red X marks were higher. So things are coming down. Valuations are going lower because the markets are pulling in. But we still have more to come. So that's why the other foot hasn't landed yet, is what we're saying. So especially when in the bear market. So this is a little busy. This is a new one. I thought it'd be a good time to roll this one out. So the S&P, since World War II, market corrections peak through trough. So declines of 10 to 20%. The bold line is the average across all correlations. So you can see where we're at as far as the bold line. Again, the average market falls 14.3% during the average correction, and the average recovery takes only 4 months thereafter. So you see it going down, hit the low point, and then to go back up is about 4 months. Just wanted to point that out as far as like a correction. We're not necessarily in a correction. It's a bear market. So the next is over 20%. So instead of 10 to 20, it's over 20. So bear market, I brought this one out. Again, going back to World War II, peak to trough declines 20% or worse. And this is, again, the blue line, the dark blue line is the average. So the average here is minus 34.6. So 34.6 is the average of bear market. So let's call it down 22, 23 in the S&P. Okay, fine. So we have some more to go, possibly. We're not sure. But then the average recovery is 2 years. So, okay, the peak was January 3rd, we're 6 months into this. Okay, we're half a year into this, if indeed it is going to hold up to the average. With the times have changed, this is looking too far back to historic. Everything's so much faster now. The declines and bear markets and corrections do not last their typical historical averages. We have it there to show you.
Sure.
But with all the information and all the AI bot trading, over 90% of the trades are just computerized trading. The point is this: the recovery will come sooner than one would think. So I don't think it's going to take 2 years to come out of this one. Is what we're saying. Mm-hmm. I thought that was interesting. So I was a little bit busy, but hopefully you like that one. That was a new one. You've seen this before: economic GDP growth minus 1.5. So we'll see what the print is for the second quarter GDP growth. Let's hope it's positive, but we'll see. Interest rates, the 2-year, 10-year, it's inverted for 3 days. A couple months ago, it inverted last week. Actually, the 5-year is more than the 10 and 30-year. It's incredible. So it was just interesting. But going back to the 2-year, 10-year, you can see how it's spiked up here in 2022 straight up, which is not good. The steepness of the yield curve. Again, the difference, the 2-year, 10-year minus 2 years, recessions are gray, shaded in gray there, or shaded. But again, the spread right now is 0.08 between the 2-year, 10-year. So that's one to point that out as well. So again, once you go below, it inverts. Typically, there is a recession that follows, whether it's 9 months to a year out or what have you. But just things to keep in mind, and we follow all this. Mm-hmm. The leading indicators, again, I took the yield curve, which is talked about, the 10-year, 2-year, and then overlaid it with the LEI, the leading indicators, leading economic indicators, or the LEI. So it's double folded here. But the current LEI is 3%. So that's the blue line coming down. And then to see the 2-year, 10-year, it's 0.08. That's the yellow or goldish line. So if it crosses 0, you can see if it crosses, you don't 100% go into a recession. It needs to be typically longer than 3 days. But typically, if it does go down, stay down, then yes, a recession follows as well. So LEI, leading in economic indicators, are falling. Hopefully, they don't go out of bed and go below 0. But you can see it's a good little overlay of the two scenarios that we use. Sure. So this is a newer chart that we like to see. You've seen this, the federal funds rate. So current rate's 1.5. They raised it 75 basis points in June. Another added tack on another 75. So you'll be at 2.25. They want to get it to around 3% or so this year in 2022. And then you can see, okay, reverse engines. We're in a recession. Yada yada yada. So, thank you, Fed. Dot plot. So again, these are all the board member meetings. Each blue dot represents a board member and their voting forecast. So you can see how, again, going higher before it reverts back down. CPI. So CPI, Consumer Price Index. So it's 8.6. Okay, it was 8.5. Then it went down to 8.4. Then came back up last month to 8.6. The CPI for June should be north of 8% as well. That's on all of our research partners are indicating that as well. So if it is hot and comes in over 8 or even near that, the point is the Fed will be forced to raise 75 basis points again because that's what they think they have to do, even though raising rates is not going to control inflation, but they think they will.
Yeah.
They're chasing their tail, but it is what it is. So a couple things on this. The components. This is a newer thing. The components that make up the CPI. So you have energy, used car prices, new vehicles, food. You have transportation services, shelter, apparel, medical care services, medical care commodities, etc. So the top 3, which are interesting, like second one in used car. So the peak you can see already peaked out at about 45% increase, and then it came straight down.
Isn't that crazy?
Yeah, it is. That's how fast things move. Right. So you can just sort of take your time and go through this. Well, it's busy, but as you look at this, Nathan will do a good job slowing this down. But the point is, there's 3 key things I want to point out. This is from Hedgeye on the call we had. So housing. Housing is the number 1 factor of the CPI, Consumer Price Index component. Okay, so that in March, housing made up 31% of the CPI components. So that number of 8.5 or whatever it was, 31% earmarked towards housing. Well, then it jumped up to 47%, folks. So shelter, housing, all that. So 47% of May's CPI number is housing, and that's on a lag. Housing is on a lag almost by 12 months. So therefore, CPI is going to be elevated for the rest of this year. We probably have seen the peak in CPI. We should have, like I've been saying. Other parts are still, components of CPI have peaked out and going down, and other parts are still going up. But you just blend it together, you'll see the trough coming over like that.
Yeah.
And then the next part, food and beverage, is now number 2. Okay, it was number 3 last time, but now it's number 2. In March, it was 13% of the CPI component. Jumped up to 30%, food and beverage. Now, I can speak to that because, a friend of mine has a restaurant, and let's just say, raising food prices 3 times this year, and people are changing their ways as far as not eating as much and or not having as many beverages, and or his diner ticket's about the same, he said. So it's interesting to hear it on different locations that he has restaurants at. So, and I hear this not just from him, but other folks too. But it's interesting how food is now number 2, 30%. So, and then the last one's transportation dropped to number 3. It used to be 43%. Transportation's dropped down to 11% of CPI.
Oh, wow.
Big movement down, and that's for your May. So, again, housing this is all May CPI components. Housing number 1 at 47. Food and beverage number 2 at 30%, and transportation number 3 at 11%. So it's just amazing how things flip flop around and move.
It's like, do you see speaking of the transport or the new cars, the average payment, $700?
I did see
$15 a month,
over $700. I did see that.
Yeah.
Didn't you and I just talk about that a couple months ago? How it was like
I think so.
6 or 5. Yeah. Now it's over 7, folks. That's crazy. Yeah. But so that's why on this chart that you're seeing, that's already done. So it's a little long, but that's what makes up, and that's what we're following. So that's how we know CPI will be sticky and elevated. It's peaked but elevated more than what the Fed wants their number to be at.
Sure.
And again, this is a little bit busy too. It's just the new chart, but stock market bull and bear cycles. So as you can see here, since 1956, World War II here, the average bear market has lasted 1 year, 2 months with a decline of 36%. So we talked about that, but you can just sort of see where we're at as far as right now we're down 24%. And you can see when you go below the 0% line on the axis there, recessions kick in. So. Did we start a recession in January? That was the peak, the trough. Okay, well, we might be 6 months into it. So we'll see. Hopefully, if we are in it, hopefully it's shallow. And then in a few more months, we hit the bottom and kick back up.
That's right. So, a lot more bull activity on that chart than the bear activity.
You got it. So that's why we wanted to share that with you, just so to put things in perspective as far as where we're at.
That's right.
And another thing is the bond market volatility, which we talk about all the time. So it's called the MOVE index.
Crazy.
The MOVE index is the volatility for bonds, like the VIX is for equities. It's the MOVE index is for bonds. So the latest print's 113, and again, the average is 82. So you can just see how things are elevated in this year. Again, unnecessarily because it's like taking a balloon, putting a balloon underwater. That's what the Fed did for 2 years, pretty much. Artificially printing money, keeping rates artificially low. Things are great, folks. No, they're not. And, voila. So things explode to the upside underwater. So that's how you relate to that. Bitcoin and dollar, we talked about this. So the dollar's on the far right. So this is June 20th. So dollar is about 105, let's call it, almost. So this is like an all-time high or near that. If it breaks out at 105, 106, on another chart that I saw, it can go much higher. So it's going to be interesting if we break out, because then it's pretty much off to the races for the dollar, and which makes sense if we are in a recession. The dollar's going to continue to go a lot higher. So, and the left axis is Bitcoin. You can see how it was 10,000 back in 2020. It's straight up to 60,000, almost 70. Remember that, 69?
Yeah.
And then boom, 20, and over the weekend hit 18.
Yeah.
So it just shows you the divergence between the dollar and the Bitcoin. So that was a great little interesting chart. And oil and dollar, same thing. Oil is on the left axis. Again, June 17th, prices, $1.17 per barrel. It went a little lower, but my point is you can see where it's at. And then to the right axis is the dollar, basically at 105. If the dollar rises in value, oil prices tend to fall, but that's not necessarily the case per se. So you can see the divergence there. So they're both sort of on the same parallel. Personal savings rate, this is a little old. This is April at 4.4. It's lower than that, folks. So all that slush fund money that these folks had, gone.
Sure.
Going back to we started out our meeting or our podcast here saying people are living paycheck to paycheck and all that. Here you go.
Sure.
So the historical average savings rate going back to 1990, 6.8. During the COVID, it got high as about 35% because all the money supply, print.
More money.
And then back in April, it's down to 4.4, which has gotten even lower than that. So,
okay. So that's a percentage of their income.
Percentage, you got it.
Yeah.
So people are, it's done, spent.
Yeah.
And when you have over 70% of GDP tied to consumer spending.
Yeah.
Hello, wake up.
Yeah.
And this is consumer sentiment. Again, consumers all help to drive the economy, make up 2/3 of spending. We just mentioned that. So this chart here just shows consumer sentiment around 50.2. And if it goes below 50, okay, that's recessionary. So they're on the brinks of just turning it over, near all-time lows for all these. The average is 85.7 is the average, and right now it's called 50. And then the last chart, monthly supply of inventories. We talked about homes, supply of homes. So remember how a couple years ago, we talked about 3 months of supply?
Yeah.
Dude, we're up to 9 months of supply already. And this is old data from April.
Wow. Yeah.
So it's gotten even more than that.
Yeah.
So this is the U-turn I'm talking about in housing. It's incredible how fast these markets are moving. So unfortunately, we're not quite out of the woods yet. We just wanted to keep it real. That's what we do here. And we've navigated as best we can and have done a good job thus far, and we'll continue to do so. Please reach out to us. I know that was a lot to digest. Sorry, folks. Woo! But as you can tell, we have fun at what we do. We track it, map it, enjoy it, and the Seuss is loose because I enjoy it on my little spreadsheets. I track it all. But please reach out to Andy, Eric, Russ, James. We're here. Yep. Stacy says hello. Enjoy your summer. And
that's right.
Yeah, try not to get too wound up over the next month and a half.
That's right.
Because it's, again, 2 steps forward, 1 step back type of thing.
Yep.
What you're going to see.
We'll get through it.
Keep the faith.
That's right. See you, everybody.
See ya.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.